Thank you everyone for joining us today for today's webinar. We are joined by a special guest, in fact, two special guests from Mutual of Omaha. We have our main point of contact. She is our go-to for everything we need, even if we're not sure exactly who best to speak with. We reach out to Maria Lara Rivas, and she's not the main presenter. I have the pleasure of introducing Stephen Alloy. He's been with Mutual of Omaha for 15 years now, but he actually started practicing law and handling financial services. He has over 40 years of experience in that industry. So we were just commenting a little earlier today about how quickly 15 years can go by.
Yeah,
Seems like it seems like just yesterday,
yeah, it
and
does.
it seems like a lifetime ago, all at the same time. So,
Yeah.
Stephen, I will go ahead and turn over control, and that way you'll be able to share your screen, and we can get moving.
Okay, great. All right, thanks, and thanks everybody for joining the call today. Hopefully, you're all looking at the screen that says tax benefits of long-term care insurance. I always like to check on that, but if not, somebody raise their hand or something. But I'm as the slide would indicate, I'm going to talk a little bit about some of the tax benefits that long-term care insurance has that are available to different types of long-term care policy owners. And basically, the tax benefits come from the fact that, as I'm sure you're all aware, long-term care insurance is classified for tax purposes, classified as health insurance. So that's as a result of the HIPAA Act it's been in effect for quite some time, and that classified long-term care as a health insurance, so it has the same deductibility that health insurance typically has. So what you can deduct, what a policy owner can deduct, to some extent depends on who the policy owner is. If it's just an individual, it's one set of rules. If it's a business, it's actually two different sets of rules. It's either a C corporation or not a C corporation, and then employees are maybe a little bit different. So let's take a look at the differences of those first. Something to keep in mind with this, we're going to be talking about the eligible premiums, and this is just a chart of the eligible premiums for last year and this year. So someone doing their taxes now for 2022, they would actually use the numbers on the left here. But for going forward and thinking about what an eligible premium is for this year, it would be the table on the right. So as you see, it goes up a little bit each year. I remember last year it really didn't go up, but this year it kind of made up for it. I guess it went up a little extra this year. So they're a little bit higher. And as you can see, each decade of age, the numbers get higher, get better. Obviously, the premium is going to be higher the older you get as well. So it kind of makes sense. But you get really over 50, it's pretty good. You get over 60. It's there's quite an allowance for premium there, so that's kind of nice. So tax premium for individuals. If someone is just an individual that buys a standalone policy on their own, they can treat the premiums as a medical expense, but like any other medical expense, it has to be combined with all medical expenses and then listed out on a Schedule A, and if the taxpayer reaches 7.5% or more of their adjusted gross income, then they can deduct anything above that. And they can deduct amount up to the eligible premium, I should say, anything above that. So the eligible premium would be what they would include in their medical expenses that they're itemizing. Couple things on this. Unfortunately, I think a lot of individuals do not get a deduction for long-term care because of this tax bill that passed a few years ago and actually is scheduled to sunset in a few years. So we'll have to see what happens with that. But that bill really increased the standard deduction. So with the old standard deduction, basically doubled the standard deduction. So with the old standard deduction, seemed to be a little bit easier to get to a point where itemizing made sense. You do need some fairly significant expenses for itemizing to make sense now that the standard deduction is so high. So, according to the Joint Committee on Taxation, it's a congressional office. It's really more than 9 in 10 use the standard deduction. So, a lot of clients aren't getting really a deduction for long-term care, although it is available. Now, with that sunsets at the end of 2025, if the standard deduction goes back to, gets cut in half again, basically, that might change, but at least as of now, it's not widely used, but it is available. If someone does have enough medical, they can get a deduction for that. Business entities, a little bit easier. They don't have to reach any particular threshold. Business owners can take the deduction more or less off the top. I mean, it's listed out on their business tax return, and even if that's their only medical expense, which is probably not going to be, but even if it is, they could still deduct it, so they don't have to meet any minimum or anything. As far as businesses go, there are only two types for deductibility of long-term care premiums. There's C corporations, and then there's everybody else. Whether it's an LLC, a partnership, S corporation, whatever it is, sole proprietor, whatever it is, everything else is considered self-employed. So, looking at the differences of it for self-employed, again, it's basically anybody who's not a C corp or not taxed as a C corp. They can deduct up to the eligible premium. They do it on whatever tax form they're using. If they're an S corp, it'd be the 1120S. A partnership would be a different form. Some single owner LLC, single member LLCs might use a different tax form, but a lot of them just use Schedule C on the regular 1040. So wherever that is, you can, they would list that out on there, and they would be able to take that eligible premium deduction. So for self-employed, and again, this is anybody that's not a C corp. It's technically it's treated as premium paid to the self-employed owner, deductible up to the eligible premium. C corporations get a little better deal though. C corporation, it's a separate tax entity. It's not a pass-through entity. So there is not only a tax return, but there's actually tax owed at the corporate level versus, say, the others where there is a form, but the tax is really owed individually. With the C corp, any shareholder who is an employee, I mean, can't be an absentee owner, but if it's a shareholder who is also an employee of the corporation, they can deduct the actual premium, and they can deduct the actual premium for that employee, spouse, and any other dependents. So they're not limited by the eligible premium. They could have, if you've got a plan that costs more than the eligible premium, in a C corp, you can deduct it. So C corps really are kind of a great target for benefits. I mean, if you run across an owner of a C corp, I mean, I immediately would think of not only long-term care, but really any benefits are, kind of treated a little better, maybe, or get a little better tax treatment in a C corporation versus, in the pass-through entities. Nice thing about long-term care insurance too, it can be offered on a selective basis. I mean, unlike a lot of plans where you basically have to at least offer it to everyone, they don't really have to offer this to everyone. Now, having said that, if you have an employer that wants to do that, I would suggest they really work with an attorney, with a counsel that really understands how to do that. Because if you do it wrong, unfortunately, it can trigger some of the benefit laws that would say, well, you didn't offer this to everyone. You're doing the discriminatory thing here. So you do it. You have to do it right. But if you do it right, you can actually carve out a group of employees and say, I'm going to offer this benefit to them and not to everybody. So that is kind of a nice thing about long-term care. Now, if someone's just an employee and the company is providing long-term care to them as a benefit, they in some ways get the best tax treatment all around. It's not just them. The business gets a nice tax treatment too. Business, however they're structured, they could be a pass-through, and they still get to deduct the actual premiums. That's for somebody who's not an owner. If just an employee, not an owner, they can deduct the actual premiums. The employee is not required to include those amounts in income, and of course the benefits come in income tax free as well. So it really, as far as taxation, really doesn't get a whole lot better than that. There aren't too many areas where a company can deduct the premium and it's not counted as income, not counted as a bonus. Because say on the life insurance side, if you're doing executive bonus, company can still deduct it on a non-owner, but then the non-owner has to take it as individual income. Long-term care do not have to do that. So it's a much nicer tax treatment. So as you know, the benefits of long-term care are not taxable, but having said that, you could reach it with certain policies. With indemnity policies, you could reach a situation where some of it's taxable. Our policies in Mutual are reimbursement policies, so they are in that first bullet of the qualified long-term care expenses. So if the benefits are going out and are equal to the actual expenses, or paid out to pay for the expenses, then that would not be taxable, whatever amount is paid out. If it's an indemnity policy, however, thinking back to that table we had on the eligible premium, also I think it had the per diem amount in there. The federal per diem amount multiplied by essentially 365 is the maximum that someone can receive on an indemnity policy before anything beyond that is taxable. So as you can see, it's a pretty good amount. In 2023, it's what is that? It's probably about 140,000 or so. So it's a pretty good benefit, but anything above that would be considered taxable income on an indemnity policy, not on a reimbursement policy. A reimbursement policy could be 100,000, and if it's actual costs, that would not be taxable. So some other tax questions that come up for us occasionally: can you pay long-term care premiums from a health savings account, HSA? Yes, you can. Can you pay them from an MSA, medical savings account? Yes, you can. How about an HRA? No, that's a yes also. Those were nice answers. These aren't as nice. Can you pay from a flexible savings account, or FSA? No, unfortunately you can't. And no, you can't from a cafeteria plan, sometimes called a Section 125 plan. Not able to pay long-term care premiums from those, but from the others, yes, you can. Another thing that is possible but might be hard to do is allowed, but you might not be able to find a carrier that could do it. The Pension Protection Act several years ago made possible a 1035 exchange from a life insurance policy or from an annuity into a long-term care policy. Now, having done that, so a lot of carriers have questioned, well, if we have a lifetime pay, how do you do a lifetime pay 1035? You can't hold the cash in the long-term care policy, and if you do a little bit a year, that's actually a series of 1035s. That's not one 1035. How do you do this? The IRS said that they were going to comment on that, and that was, I think it became effective in 2009. And I guess they've been busy, but they haven't commented on that yet. So a lot of carriers, in fact, I'm not sure. I know one or two carriers used to. I'm not sure any carriers will still actually do a 1035 into a long-term care policy. It's allowed, but it's kind of practically hard to do. If we ever get back to single pay or short pay policies, that would be a little bit easier maybe, but single pay would be. I don't know. The short-term pay might still be the same problem, but is something that's allowed by the law, but might be hard to actually implement. One workaround that I've seen a lot of producers do for this is they'll do a 1035 into a SPIA, and then they'll use the SPIA payments to pay the long-term care premium. It's it's not some of that SPIA distribution is going to be taxable, so it's not it's not a perfect it's not really like a 1035, but it's probably the closest workaround that's there. And based on their age, not a lot of the SPIA payment is likely to be taxable. Particularly, the older they get, the less is going to be taxable. So, some of it would be, but it might not be enough that it would become less attractive. Return of premium is basically, and people ask, well, hey, if I get the return of premium, that's not taxable, is it? There really isn't a short answer. This is a longer answer. Most of the time, it's not taxable, but it would be taxable to the extent that you took a deduction. So, remember we were talking earlier about how not many individuals really actually get a deduction because they're taking the standard deduction. Well, this is a case where that might actually be a good thing, because if they have a return of premium policy, then if they never took a deduction, the return of premium's not going to be, none of that's going to be taxable. So, but if say, a business, for example, is taking the deduction every year on an employee, and then, and there's a return or on the owner, let's say, and there's a return of premium. Well, if that owner got the eligible premium deduction, then, some of that return of premium is going to be taxable, or all of it if it was below the eligible. So people ask sometimes about gifting. Yes, there are limits to gifting. I mean, the annual gifting limit is this year $17,000, per donor per recipient. But medical care has kind of a special gifting exception. If you gift medical, if you pay for somebody's medical care, it has to be paid directly to the provider. But if you pay for somebody's medical care, there's no limit on that. That's considered an allowable gift, and you don't have that 17,000 limit. In fact, it is unlimited. That applies also to long-term care premiums. So now, unfortunately, only the eligible premium can actually be considered the gift, the unlimited gift, and then the rest would apply toward, if it's more than that, it would apply toward the annual gifting limits. But it does have to be paid directly to us or to whoever the carrier is, to make that, to achieve this kind of gift. But medical expenses do enjoy that unlimited gifting ability. We've talked primarily about federal tax incentives, but a lot of states, particularly, states that have a state income tax, a lot of them have some sort of state incentive for having long-term care insurance, and some of them are quite good. In fact, I know a few states. There's one state, I'm trying to remember which state it was, but was basically it has a proposal out now that is going to allow literal, like a dollar for dollar deduction of long-term care premium from state income tax. So, I mean, if you get a nice enough policy, you might not owe anything. So that's kind of nice. I'll see if I can remember what state that was, but but a lot of states do have very nice tax credits or tax deductions for having long-term care. So I would check, since it varies so much state by state, I would check with the American Association of Long-Term Care Insurance, check on their website, because they break down state by state a lot of the state incentives. And speaking of states, I'm not going to spend a ton of time on this, but you're probably all very familiar with the state of Washington, the Washington CARES Act, as it was called, that was passed. I guess it actually was passed in 2021, but started to become effective at some point last year. Literally, or actually, it was going to be, they were going to start collecting the tax in January of this year. Literally, the same people who had passed it not that long before, because there hadn't been an election in between. So it was literally, it wasn't just the same legislative bodies, it was literally the same people, voted 91-6 to hold off on implementing it because they realized they forgot a couple things. So they are still on schedule as of now to begin collecting the payroll tax July 1st. And the reason I'm bringing this up is Washington State was the first to really pass a law along these lines, but there are a lot of states that are looking at doing something very similar, doing the same thing. So, to the extent that in the next year, 2 years, 3 years, I mean, it's going to take a while for all this to happen, but in the next couple of years, 3 years, handful of years, I think it's really a great time to talk to people about long-term care so that they can get good care, the care they're really going to need, and can opt out from programs like this. Because at least if the other states follow the Washington model, they will allow for opting out by those who have long-term care in place. So, and depending on the opt-out, you may already have to have it in place by the time the bill actually passes. So I would say, now's a good time. There are probably about 15 or 16 states that are looking at doing something like this. And, most of them are the more populous states, but not all. I mean, there's some states you would never expect would pass a payroll tax that are looking at doing exactly the same thing. So I think the next few years is really the great time to get long-term care in front of people, because, well, just one more thing on this. The reason I think people would want to opt out of this, other than just, nobody likes paying taxes, right? But other than that, the payroll tax, it doesn't sound like a lot. It's 0.58% of their payroll. So it doesn't sound like a ton, but if you think about it, if somebody's making $200,000, that's around $1,200, and the maximum lifetime benefit that anyone in Washington can get is $36,500. So you think about that. Think of it, you're going to be paying, $1,200 or more as your income goes up. You'll be paying more, and that's the maximum benefit you're going to get. I mean, I'm sure you can find a lower cost way to get that little a benefit, and you can probably, for that same dollars, you can get real benefits that would actually do something for them. And 36.5 is, I'll give you a couple months, but it's really not going to do a whole lot for you in the scheme of long-term care things. So that's why I think really getting good care into people's hands so they don't have to do these is I think that's the number one project for the next few years. So another great tax benefit, and this doesn't really apply to a lot of people, but the ones it applies to, this is a nice benefit. If you have clients who are in the retired public safety employee plans, they can, there'd be retired police, fire, it would include chaplains, EMTs, anyone who had worked in that position and would be part of this plan. They can deduct they can withdraw, I should say, up to $3,000 per year from their plans. And as long as again, this has to go directly to the carrier. But if they do that, they can buy long-term care insurance for themselves, spouse, any other dependents. So pretty nice benefit. Again, it doesn't apply to a ton of people, but if you got clients that applies to, that's a pretty good benefit. So I'm not going to talk a lot about the partnership program. It's a nice way of protecting assets. I mean, you're probably, you're all probably more familiar with it than I am, but it's something that I think we tend to think of long-term care, and it's classified for tax purposes as health insurance, but I really tend to think of it as asset protection, because and this is one of the ways that it is asset protection, that it literally can protect assets if you're you find yourself in a kind of a near spend down situation. And it also just protects you from having to liquidate all your assets to pay for care. So I think it's doubly an asset protection device. And the partnership is a nice part of that, a nice way to help protect assets. So with that, this is us, and I'll unshare my screen because I know there's something else that I think needs to happen here on the screen, right?
Yes. Thank you so much, Stephen. And yes, in fact, all of those, the contact information that you see up there, Mutual of Omaha has their advanced markets experts. If there are additional questions or something that you would like to see answered in more detail or something tax related, if we glossed over something a little quickly, their entire team is really, really good at keeping an eye on some of these things. The taxation, the Washington State program, they're really good, and they're there to answer your questions. So before we get there, I certainly, let me see here.
Well, I switched over
I will,
to you're the presenter now.
I can show my screen. Let me see. But it looks like we do have a question first.
All right.
So Kevin had actually submitted a question that he wanted you to elaborate on the gifting. Kevin, are you with us?
Lynn, can you hear me?
Oh, there we are.
Yes.
Yes. So your question you submitted through the chat was very brief. What specific part of the gifting part of that did you want Stephen to go into a little bit more detail?
Yeah, quick preface to that. Great job yesterday in your presentation, Stephen, and also today. Thank you so much for your time and expertise.
Oh, great. Thank you.
Have invited you to connect on LinkedIn. I would love to be able to follow you.
Okay.
As far as the gifting goes, and Lynn, I think this goes back to what you were saying. Is that specifically for someone who, if my wife and I are able to pay for someone else's health expenses, if we pay for their expenses directly, there is no limit to what we can pay. Is that correct?
All right, that's correct. Yeah, if it's the only limit would come in, and it's really not a limit per se, but the only limit would come in if you're paying their premiums, their long-term care premiums, then you'd only the eligible premium would fall under that unlimited, and the rest, anything if you're paying more than that, then it would have that would apply against your annual limits. But yeah, if you're paying for the actual care, no, there's no limit.
And to confirm what I think I heard you just say, if someone is paying another person's long-term care insurance premium, that can be gifted as well.
Right. Oh, yeah.
Up to $17,000. So who traditionally pays or historically pays someone else's long-term care insurance premium as a gift?
Yeah, that's a good question. I trying to think if I've actually seen this in practice. I could imagine you might have a situation where, maybe a retired parent, and then maybe one of the kids that's, done a little better, made a little more money, might pay that for the parent.
That was actually going to be the example I used.
Okay, well.
Suggesting an adult child who's maybe taking care of mom and dad.
Yeah, that's probably where it's going to come up the most. Because I don't see a lot of people saying, "Hey, can I go pay somebody else's medical expenses?" You don't see a ton of that, but I think you might see it in taking care of retired parents or something.
Perfect. And Lynn, Stephen, if either of you have any additional resources, that a white paper or something of that nature that would lead me to better understand that opportunity in sales, I would love it. And I thank you in advance. Appreciate you both. Happy Thursday.
Oh, thank you.
Thank you.
Thanks.
What I will explain though is when the email goes out that includes the voucher as a thank you for attending today, I will check with Stephen to see about obtaining copies of the slides that he used today as well.
Mm-hmm.
I do plan to link to the Mutual of Omaha tax guides. Not only do they have the individual tax guide for, of course, 2023, but they have the 2022 year materials as well. But they have the consumer tax guide, they have the tax advantages for small businesses, and they do actually have an agent-facing tax guide that goes over a lot of detail as well. I'll be linking to all three of those in the follow-up email. That will also include the recording of today's presentation and those slides, if Stephen is willing to share those with us. So,
oh yeah, I can get those to you.
Okay, perfect. So what I'll end up doing then is I'll go back and we are drawing 3 winners. The big prize is actually a Mutual of Omaha gift bag of swag. And we have tumblers, we have a coffee mug, we have a nice bound journal. They have some information about their Wild Kingdom shows and where you can find them online. So we'll actually draw the winner of the gift bag first. So I'll go ahead and spin the wheel. It's so satisfying seeing those colors. And the winner of the gift bag of swag is Gary P. All right.
Cool.
And
Congratulations.
Yes, what I'll end up doing then, we also have 2 individual winners that will each earn just an individual gift, an individual swag item. So just one item, but important nonetheless. We are going to draw 2 winners for that individual piece, and Julianne B is the first winner. Congratulations. And our final winner for that Wild Kingdom swag. Oh no, Julianne, perhaps instead of the single item, you will get 2 different things. So
there you go.
Everyone,
wow. Way to go.
Yes.
All right.
Well, thank you everyone for joining us today. Kevin, that was a very good question on the gifting. I know that I'll do what I can. Stephen and I will touch base and perhaps get Maria involved as well, just to see what we're able to find in terms of a white paper or additional resources that would provide more detail on the gifting. And I think that's everything. Thank you everyone for joining us. Again, it's time taken out of your day, and we didn't even go as long as we'd planned. So excellent. You did a great job, Stephen, covering all of this material. Being that it is tax season, it is extremely helpful.
Oh yeah.
I know everybody's looking for those tax questions to be answered. So again, thank you for joining us. If you have questions to anybody who's on, feel free to reach out to our GoldenCare team. You can reach us at 1-800-842-7799. For those winners of our Wild Kingdom prizes, be on the lookout. We'll be reaching out to confirm your mailing address. So we will be reaching out either by phone or email. And again, thank you everyone for joining us. A special thank you to Stephen and Maria for coming on as our special guest speakers. And definitely give us a call if you have any questions.
Hey, thank you, Lynn.
Thank you, everyone.
Absolutely. Everyone, take care.
All right, thanks. Thanks, everybody.
Check out our website, goldencareagent.com, or give us a call at 800-842-7799.